Now, let's understand why it is so important to model prepayments. So, why really the big fuss behind prepayments, and why do we have so many sophisticated models around prepayments? Now, this is because MBS securities offer the facility for borrowers to make prepayments, or they can make earlier payments on their loans. The idea is if they can prepay their loans, they can naturally curtail the overall loan period. So that is naturally going to save on their interest expense, isn't it? Because if, let's say, my initial loan period was 30 years, if that loan period through prepayments, I'm able to bring it down to maybe, let's say, 28 years, then the last 2 years, whereby I would have had paid interest, that gets saved because I'm prepaying the loan. So that's why understanding prepayments is important, because this is going to have an impact on the returns which will be earned by MBS security holders. And that's why banks spend a considerable amount of effort whenever they are doing modeling of such prepayment rates. Now, it is observed that prepayment of principals is fast. Now we naturally know that whenever prepayments quickly happen, that is going to result in a diminishing principal. And if your principal amount is diminishing faster, or it's reducing faster, that is naturally going to have an impact on the overall interest calculation. That is, the interest calculations are also uh, going to get curtailed, I would say, as compared to the earlier loan life. Because that way, if your loan amount is getting prepaid earlier, then naturally you have a chance of saving on interest. So that is something which impacts investor returns. Now, for a modeling purpose, there are two quantities which are generally used. One is a scheduled prepayment, and other is the unscheduled prepayment. Now, a scheduled prepayment is these that amortize the principal as per the original schedule. So that is something which is like a known quantity, I would say. So these are the scheduled prepayments. There is something which we call as an unscheduled prepayment. Now, this is something which has an impact which is higher as compared to uh, the scenario whereby there are no prepayments. Now, this is a scenario whereby borrowers might want to benefit from either prepaying the loans in some way, maybe either a turnover or maybe refinancing, whichever. But that implies that the borrowers are going to repay the loan quickly. And this is what we try to study under the idea or the gamut of unscheduled prepayments. Now, for the examination, remember that we measure the principal amount prepaid as a percentage of total principal outstanding. So, whatever percentage calculations, etc., which we may have to calculate on the examination, these should be calculated based on this idea or this logic. And this is the reason behind modeling of correct prepayment rates. So that's why banks, financial institutions, and even savvy investors, they are going to spend a lot of effort, maybe building advanced quantitative models and also using their technical know-how in the market to try and model the prepayments in the best way possible. Because this is going to give them a fair idea as to what is the kind of return which they can expect on their investments in MBS securities. Now that we know why modeling of prepayments is important, it would be a good idea to understand a couple of terminologies. So we start with SMM, or what we call as single monthly mortality. Now, SMM is defined as the a percentage of principal outstanding at the beginning of a certain month N that is prepaid during that month N, where these payments are excluded from the scheduled principal payment. Because if it's a scheduled principal payment, then we know, that is the kind of prepayment which was going to happen. But something which is higher than that, what we call as an unscheduled payment, that is something which we try to relate with the idea of SMM. So this is technically the definition of SMM for any month. We have kept it as generic month N. This can be any month basically. Now, to understand these calculations, we'll assume that a certain MBS mortgage pool is going to prepay at a certain constant rate equal to SMM. Now, going through the table below, now to understand the amount of principal that remains at the end of the month, we simply take a difference between 1 minus SMM of N. Now, if we want to extend this to 1 year, now this was like 1 month. Now, if I want to extend this to 1 year, I simply need to take 1 minus SMM for the month N raised to 12. 12 because there are 12 months in a year. So this gives us the amount of principal that remains at the end of 12 months, that is 1 year. Now, further, We could also want to know what is the amount of principal that was prepaid, because the first two calculations told us the amount of principal that remained. Now, if you want to see the other side of the calculation, that is, if you want to see what is the amount of principal that was repaid during the year, we simply subtract this quantity 1 minus SMM raised to 12 from 1, which is shown right here. So this gives us the amount of principal that was prepaid during the year. So these are just the two sides of the same coin. So this is how we can understand these simple calculations. Now we can relate SMM with the idea of CPR, or what you call as a conditional prepayment rate, another important quantity, and these two are related ideas. So firstly, CPR is an annualized rate, whereas SMM is a monthly rate. Again, something which you need to keep in mind for the examination. So there can be a question which talks about the way in which these rates are mentioned. So at that time, remember, CPR is always the annualized rate, SMM is a monthly rate. Now, two quantities are related, they are not independent of each other. Now, CPR is 1 minus, or basically, this is the similar formula which we had seen in the previous table. So, this gives the CPR for a certain month N, and we can simply rearrange. Now, it may so happen that we have been given the number for CPR and we have to imply SMM. Simple. You have to simply rearrange this equation, and that's how we can calculate SMM, or the other way around. So on the exam, you may either be given, let's say, a CPR or SMM, and you may have to calculate the other. So you can simply rearrange this formula, and we get to know the CPR for month end or SMM for month. So just to demonstrate this through a very simple calculation. Now let's say there is a certain mortgage pool which prepaid 0.5% of the principal above its amortizing principal in a given month. That is, we can imagine that this is something which is above the scheduled principal payments. Now, if we are to calculate the CPR for this pool, we can use this formula which you have written right here, whereby we are calculating CPR for a certain month. So it is 1 minus this 0.5%, which was the additional prepayment which happened. We just take this difference raised to 12 and we subtract it from 1. So that gives us a number of 5.83. Now, way to interpret this 5.83, that is, we expect 5.83% of the principal outstanding at the beginning of the year to be prepaid by the end of the year. So that's how we can understand this number of 5.83%. Now, let's relate this further to another important benchmark, which we call as a PSA benchmark for short, or a Public Securities Association prepayment benchmark. So, a PSA benchmark is defined, or it's expressed as a monthly series of conditional prepayment rates. Now, there is a benchmark level for a PSA which is defined. So, that's taken as 100 PSA. So, this we assume as the benchmark number, and this is something which we use for comparison. So if the PSA assumption is greater than this 100 PSA benchmark, this indicates that the prepayments are assumed to be faster than this particular PSA benchmark. Whereas if the PSA assumption taken in the calculation is lower than 100 PSA, that implies that the prepayments are assumed to be slower vis-a-vis this PSA benchmark. Now the 100 PSA benchmark assumes a CPR of 6%. So again, this number of 6% is something which we are going to use in our further numerical demonstration. So remember this value. Now we are going to bifurcate the calculation into two time periods. So one is a time period starting from 1 month to 30 months, or 1 month to 29 months to be precise. And from month 30 onwards, the calculation changes. So let's see how this 100 PSA number is going to come in. So for months 1 through to 29 for a certain mortgage or mortgage pool, we have a 100 PSA calculation, which will be the number of months upon 30 into the 6% CPR, which we take as the benchmark, into 1. Whereas for month 30 onwards, this will change. Now it will be 6% into CPR into 1. So these two are the calculations which you'll have to keep in mind. So there may be questions whereby computations might have to be done around these numbers. So always remember that there is one set of calculation which is valid for the period 1 month to 29 months, and from the 30th month onwards, that computation is going to change. Now this is for 100 PSA. Now it may so happen that we may want to do the calculation for other PSA. That is maybe a PSA number which is either higher than 100 or lower than 100. So we can use a similar formula. Only thing is we'll have to make a small adjustment on top of this. And we'll demonstrate the adjustment in a bit. Now, before we go there, remember that the 100 which we have written here, oh sorry, the one which we have written here is nothing but 100 upon 100. So the same thing happens here as well. The one which we get here is nothing but a simple ratio of 100 over 100. That's how we get 1. Now, why I'm mentioning this point? Because whenever we are doing calculations for a PSA rate which is other than 100, these factors are going to change. Now, don't worry. Now, how that calculation is done, we are going to study in a simple numerical example, so we know how exactly that calculation happens. Now, we have a small table at the top, whereby we have taken months 1, 2, and 40. So the idea behind taking these months is we can demonstrate something which happens prior to month 30 and something which happens after month 30. So that's why we have taken these months. Then we have taken different CPRs and SMMs. So we have taken PSA assumptions of 50, 100, and 200. So the idea was to demonstrate how exactly to handle calculations which are other than the PSA 100, because PSA 100 thing is already something which we have covered earlier. But how to handle a PSA 200 and how to handle, let's say, a PSA 50, and similarly for SMM, that is something which we'll try and understand through this very simple calculation. So let's see how the calculation works. So for month 1, we do the calculations for 50, 100, and 200 CPR, and we do a similar calculation for SMMs as well. Now this will be focusing on month 1 number. Now whatever you do for month 1, we know that naturally you can apply the similar calculation for month 1 through to month 29. So we'll just do it for 1 month for demonstration purposes. Now CPR for 50 PSA. Now this will be 1 over 30 into 6%, which is the benchmark CPR, into 50 by 100. Now this was the factor which I had mentioned earlier. So if you recollect, in the earlier table we had simply taken a 1. And at that time I had mentioned that 1 implies 100 over 100. Now here the PSA assumption has changed. We are taking a 50 PSA. So that's why this factor changes. Now this cannot be 1 now. It will be 50 over 100. So that's why this ratio. This gives us 0.1%. I do a similar calculation for CPR of 100 PSA as well. Now here again, for keeping uniformity in the calculation, I have kept this as 100 over 100. I have not taken it as 1 directly. So a similar calculation applies for 200 as well. So this is the CPR bits which we do for 3 levels of PSA. Now let's see how the SMM gets calculated. Naturally, we know that CPRs and SMMs are related ideas. So we can use the SMM formula which we had discussed earlier. So SMM for 50 PSA will be 1 minus into bracket 1 minus the earlier calculation of 0.1%, which you have done. So we have 1 minus 0.1% raised to 1 by 12. That gives us 0.008%. A similar calculation is applied for SMM of 100 PSA and SMM of 200 PSA. So this is how a simple calculation for month 1 can be done. Now, if you see, we have a benchmark CPR column here. Now, the benchmark CPR numbers will exactly tally with the 100 PSA CPR, because we know that 100 PSA is the benchmark, right? So that's why you'll see these numbers exactly tallying, that is 0.2, 0.4, and 6% is exactly tallying with what I have called as the benchmark CPR number. Now, a similar calculation gets applied for month 40. The calculation is very, very similar. Only thing is we have breached the 30 months timeline, right? So the formula has to change. So if I just step back for a moment, the 100 PSA we know is 6% into the CPR into 1, which is again 100 over 100. So this is something which I would want to use for my month 40 calculations. I do a similar calculation for 50, 100, and 200 PSA using 6% into the respective values, 50, 100, and 200, and we get to numbers of 3, 6, and 12% respectively, which we have basically tabulated here as well. Similarly, I can do the SMM calculation again, a similar calculation to the earlier exercise. For month one, we can calculate SMMs for all of the three values of PSA 50, 100, and 200, which gives us 9.65, 18.63, and 34.69 respectively. So this is how we can approach these kind of calculations. So again, just to reiterate, for month 1 through to month 29, the calculation would remain similar to the first column in the table, whereas month 30 onwards, we switch to the second approach. So here we have done the calculations for different values of PSA. So on the exam, if we have some other PSA, let's say a PSA assumption of maybe 60, it's very easy, right? We just need to change the factor, and that way we can use it in the calculation to arrive at the solution. So this was the idea behind this demonstration, explaining the relationships between CPRs, SMMs across different values of PSAs.